Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti, and we are thrilled to have you with us today here. In today's webinar, along with Sudhir Pai, we have with us Anup Nayak from My Time Equity. Before we start the webinar, I'd like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slide that our attorneys mandate that we show prior to every webinar. If you have any questions during the presentation, please feel free to type them in the Q&A box and we will have them during the Q&A session. If you need Sudhir Pai's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Yeah, thank you, Jyoti. Can you hear me?
Yes,
Hello?
I can hear
Okay.
you.
Okay.
Yes,
Okay,
I can
great.
hear you.
Yeah, thank you. Thank you. And thank you very much, all the uh, you know listeners who have joined us today. Thank you for joining. So, quick recap of the market. Markets were a little bit of redness in the market. We saw both S&P and Nasdaq both down 0.5% and 0.3%, whereas Bitcoin and gold gained. Bitcoin and Ethereum and all the altcoins really had a good rally. We saw Bitcoin at around 103, and we think this rally is going to continue, given that there is a lot of monetary stimulus that is happening all over the world. So whenever there is new currency printed, quantitative easing and all of that, uh, properties as well as Bitcoin increases in price because these are scarce assets. Gold took a little bit of breather last week, but this week again, with the news of China accumulating gold and Fed not lowering the interest rate any further because Fed feels the economy is very strong given the numbers on the unemployment claims, employment numbers, as well as the inflation and the earnings of all the 400 plus S&P 500 companies. All the numbers look very good. The reports look very good, and the GDP numbers, which were on the lower side, for the last quarter, for the month of March, for the last quarter, uh, was clearly the reason for that was higher imports, and that was kind of not taken very seriously by the market because the hoarding of items, the hoarding of imports through imports was very high last quarter because of the tariff concern. So that is what skewed the GDP numbers. But with all the other reports which I mentioned, the Fed is very comfortable and they don't expect to lower interest rates. Uh, you know, is the indication that we got from the FOMC meeting. And because of that, the market started, rallying. And last 2 days we have seen, either a up market or a flat market, and the cryptos doing extremely well. And coming to the earnings, as I mentioned, earnings of 400 plus S&P 500 companies are extremely good. The estimates were around 8%, whereas the numbers that we are seeing so far from Q1 of for the S&P 500 companies is around 12%. With that, we are seeing the growth-based stocks really take off, and we are seeing okayish returns in value. But we are still cautious because technically when you look at the chart, we are between 50-day moving average and 200-day moving average, which means 200-day moving average means 1 year worth of 1 year's average price point. So once we cross that average price of 1 year on S&P, which is around 5,700 points, we continue to feel that the bull market is on. Otherwise, we may think that this is a bear trap, which means the algorithms that play in the equity markets are trying to trap the bulls and trying to generate some profit. So at this time, our models are around 83%, around 73% in risk on assets, equities, and 27% in treasuries, fixed income treasuries. And coming to the tariff discussions that are going on, US saw its first contract with UK. The news was really celebrated by Wall Street, but when you really go in deep and see what exactly is the deal, um, it doesn't look like a great deal, because UK is a country that has a trade surplus with the US. So US really has a problem of trade deficit, and they are trying to lower the trade deficit, whereas UK has a surplus. And this deal doesn't really mean anything from the emerging markets like the Asian countries like China, Taiwan, uh, you know, uh, and other countries in Asia who have a huge trade surplus, and US has a trade deficit. The problem is there, but the media, the narrative was that the trade deal was done with UK, that was celebrated by Wall Street. We saw a good market, but then when you go deep, it's not the kind of uh, contract that the Wall Street should really celebrate. But the White House is of the opinion that you do a contract with one country, the other 170 countries will follow. But personally, I don't think this is going to be something very easy. And this weekend, which has already started, discussions are on with the Chinese officials. And if we see good results coming out of those meetings, Treasury Secretary Scott Bessent and the Chinese officials are meeting to have high-level discussions about, the trade agreement with China, which is the big beast in the room. And Trump has clearly said through the UK contract that 10% tariff, even for a country like UK, where US has a trade surplus, is going to remain. 10% is not going away. So it was that point came out very clearly that 10% is going to remain, and US is going to have revenue from the from international tariffs. And the other point that we have to now wait and watch is how the transaction is going to happen with China. So we are cautious because of that. Over the next 2 days, anything can happen. If the discussions are going positively, I think the market will continue to rally next week. We are very confident of Bitcoin and other cryptos rallying because of the monetary, uh, you know, reasons, because there is M2 supply of money on the balance sheet. Because of that, cryptos will rally, but stock market, we have to go slow. So we'll keep you updated. Every day we post a message in our WhatsApp group where you will be given the latest information of that day's market conditions. Next slide, Jyoti. So finding opportunities in this volatile market, So the topic of today is, should we be, invested in US, or should we be diversifying in other countries? If you look at the table on the left, you will see that US equities have underperformed the uh, foreign country indexes. US S&P 500 is down by about 3.7% year to date, whereas countries where the discussions are going on and where there is a trade deficit, those countries are doing extremely well. For example, China, Mexico, Japan, Germany, Europe, all of these countries have deficits with the US. You know, they have trade surpluses, and that's what US is trying to solve. And those countries are rallying. So that's a very clear message that, you know, that tariff is going to hurt American companies. US consumers are going to pay much higher price for the the stuff that they use, and all that is making the money go out of US, and it is getting pumped in other country equity. So, you know, we continue to be of the opinion that, you know, European stocks are going to do very well because they are quite cheap right now. What happened over the last 2 years? You know, we saw huge momentum in American companies stocks, particularly the Max 7s, which are almost 40% of S&P 500. Those really rallied a lot, almost up to 50-52% over 2 years. And that money now has to find its home because American stocks have become very expensive. Even after the correction that we saw in April, we are still at around 22 multiple, you know, on S&P 500. So we think that this movement of money from US to other nations is going to continue, particularly, you know, the cheaper countries, because money did not flow in those countries over the last 2 years. And for a country like China, which really has not done anything since COVID, the stocks are extremely cheap. You know, so our international model, which I'm going to show you after, you know, a couple of slides, will clearly give you an idea on how our international model has done, how Chinese model has done. But the reason why we are kind of having this topic as a discussion is for you to learn that, you know, there is opportunity outside of the US equity. Okay, so very, very important point to consider, and diversification is the key. And diversification this year in international stocks, I think will make a lot of sense. Next slide. Okay, so this slide shows, you know, the trade deal with the UK and where do we stand with other countries. So this UK deal, as I, as I said, you know, when we were talking about, the trade deal with the UK, when we were discussing the first slide, it's very clear that, you know, the contract with the deal with UK is just to create positive sentiment, just to tell the world that whoever has not retaliated with US gets the best deal, and even that best deal comes with a 10% tariff. So the message was very clear. But if you look at this particular chart, it clearly tells you that countries, you know, like China has a very, very big trade surplus and US has a trade deficit. The next is European Union. After that, it's Mexico, Vietnam, Ireland, Taiwan, and Japan. So contracts with these countries may take a little longer, and you know, we think till this uncertainty of trade deal is gone, we are not going to see the impact of tariff on our consumers, on our companies, and equity markets don't like that uncertainty. We also have the tax bill yet to be released, which is going to happen somewhere around the Labor Day, July 4th. So between now and that day, you know, we are being cautious, and we are also diversifying the money to other assets like cryptos and other countries' equity, gold, silver, platinum, copper, and all of that. You know, but this slide will give you a good, you know, picture of where we stand in terms of the negotiations that we are having with different countries. So there is a lot of work that White House is yet to complete. Next slide. Next slide, Jyoti. Okay.
Yeah, it is loading.
Yeah, so this slide shows you how the money has moved, you know, or the equity markets have seen the money movement. So if you see this slide, it shows very clearly that the markets are up only because the retail clients are buying the dip. The institutions are net sellers. The hedge funds are net sellers and they are playing with the volatility. Hedge funds make money when the equity markets are very volatile. Last 2 years, hedge funds have not done very well. But this year, we are seeing hedge funds do extremely well. And that is why, we have investments in hedge funds. And we will show you some ideas of hedge funds where you can invest through my time equity. Uh, about 4 months back, we got an opportunity to invest in Millennium, which is America's third best hedge fund. They have consistently given an average return of about 18% per year. And getting a position in that hedge fund is extremely difficult. So we have access to such hedge funds but to invest in those hedge funds, you need to be a qualified purchaser, not just accredited investor, which means, your net worth has to be in excess of 2 or $5 million. But we do have those opportunities. So what this slide clearly shows you here is that the retail clients are the buyers and the institutional and hedge funds are sellers, which is not the best thing, right? Because we want institutions to buy, we want the pension funds to buy, we want the retail to sell, because retail, when they sell, it is backed by either fear or greed. But we are seeing retail actually buying, and that is one of the concerns that we as a wealth management firm has. So we are being cautious again. We are not 100% in equities. We are holding money in treasuries to the tune of about 27%. So once we see conditions improving with China, once we see, the technical indicators cross the 200-day moving average, and once we see some institutions putting in money, I think we will go 100% back in the equity markets. Okay, so that's our stand. Next. I covered this topic as well when we were talking about the first slide. US market is very strong. Labor market is holding well. Wage growth is still above the historic numbers. And spending, which happens to be 45% of US GDP, continues to be high, service spending. So as long as we don't see too many job losses, as long as we don't see inflation coming back, I think we can assume that the US economy is very strong. Next. So what are the news, what are the macro news that are going to show up next week? The CPI numbers for April, which is expected to be around 2.4%, will be released on Tuesday. And retail sales, which kind of indicates the sentiment of the consumer, is expected to be released on Thursday. So if both these numbers come as per the estimate, I think the market will continue to rally. But for any reason, if the CPI numbers come out hot, meaning they are in excess of 2.4, that can send a very negative message to the market and it can start selling. Similarly, if the sentiment of retail sales is down, we can see some pressure in the equity markets as well. So, we watch these numbers very, very carefully and we take steps on how we invest our clients' money. Next. Performance of our models, as you can see on the left hand side, SPY was minus 0.43%. So the market was down for the week. Year to date, we are down by 3.42%. Gold was up by 2.97% for the week. Bitcoin was up 6.49% for the week. Coming to our models, our models performed very well compared to the equity markets in general. International took a little bit of beating because the money got pushed into US markets. The money came back to the US markets because last 2 months, international has been doing very well. So if you look at the year to date numbers of the international model of ours, it's up by about 10.79%. In that international model, we have China, we have India. India took beating because of this whole war situation that's going on. That's why international was down. Europe did very well last 2 weeks. This week it was down. So overall, if you see, international was kind of flat, 0.14% negative. And if India war had not happened, I think we were still in green. But unfortunately, the war, which hopefully will end soon, uh, caused a little bit of stress on the market, equity markets. Small caps, mid caps did very well. Next generation innovation stocks took a little bit of beating. When you look at, our contrarian model, it has been doing very well. In the contrarian model, we have, some international, we have, countries like or Greece, Poland, you know, platinum as a commodity. So it's a very contrarian bet that we take in that model. So if you're interested in investing in that, you may want to consider that. You can tell us and we can put your money against that. And our custom model, which is where most of our clients are and which is actively managed model, where today, we are sitting on almost 27% of treasuries. Our model was 0.9% in margin and 0.51% in regular model. Was a pretty good number compared to S&P 500's negative 0.5. So we did well last week. Next. So as I mentioned, our goal as part of um, our service to you is to beat the S&P 500 by about 2 or 3%. That's our goal. And we actively manage money so that, we are not leaving money to God. We just don't leave money, because, it all depends on how much of a stress the equity markets will go through. And sometimes, it may take markets almost 2 years for it to come back to the level at where you started. So since we are a 2-year-old company, clients are approaching us with their new money. Uh, it's very hard for us to take all your money and put it directly in the equity markets, which is where, we have other ideas which works perfectly very well given the uncertainties that are looming and the volatility that we have in the equity markets. This particular structured note, for those who are joining my webinar for the first time, structured note is a note issued by one of the biggest banks in the world. In this case, it's Morgan Stanley. This bank issues a note which says that your money is protected, principally protected. That means you will never lose money if you invest in this note. Second, the money that you invest in this note is being invested in three stocks: Apple, Palantir, and Dell. So all three stocks are S&P 500 stocks, very large cap stocks, good companies which has a solid moat. Apple and Dell technology companies, huge number of clients. One is in the mobile business and Dell is in computer business. Both are very focused on AI, um, doing extremely well. Has some issues, Apple is facing issues with China and the manufacturing and the sales of its Apple phones in China. But, you know, uh, we all know that every company will have its own challenges. And Palantir, a company which has huge potential in terms of government contracts, These are the three companies we have chosen, and the bank is technically saying that this is a 5-year note, but it is liquid anytime. You can sell this note anytime in the private markets and get your money back in like 2 to 3 days. So it's a very liquid investment. You're not locked up in this like real estate investment. And what happens here is, at the end of 1 year, so it's a 5-year note. At the end of 1 year, if all three stocks are priced at the same level as the trade date, which is May 30th, so you have time till May 30th to invest in this note. So you make 15.5%. If the price is unchanged of all three stocks, or if it is up, you make 15.5%, which is a great return for a principal protected note, right? Because if you look at S&P 500, with all the ups and downs corrections, it generates about 10% return on an average. 2022 was a negative 23% return. 2024 and 25 were positive 20% plus return. So far, S&P is down by about 4%. So, this note gives you that comfort that my money is completely protected. I am not going to lose my money. Two, if the three stocks are positive or flat after 1 year, you make 15.5%. So if you put 100K, you make 15,500 more on your money and your money will be returned back. Now, what happens if these three stocks are not positive at the end of year one? It straight goes to year five. But as I said, you can always sell the note and take your money out. You will make money as long as these three companies have not declined in value. Now, at the end of 5 years, what happens? At the end of 5 years, you get 1.25 times, not just one time, 1.25 times, meaning 25% more than the actual growth of the lowest performing stock. So let's say, Apple has gone up by 100% in 5 years. Palantir has gone up by 300% in 5 years. Dell has gone up by only 50% in 5 years. So you get 1.25 times of 50% because Dell is the lowest performer out of the three stocks. Now, what happens if one of the stock is down or all the stocks are down, in 5 years? It's very hard for you to see an S&P 500 stock down after 5 years, right? Because stocks usually are up 80% of the time, it's down 20% of the time. And whatever comes down has to go up. And usually we have seen the recovery period of a stock to be 2 years. And in times like COVID, it has happened within 2 months. What we saw on Liberation Day, where the market took a beating of almost 20%, over 3-4 days, we saw the market come back within a month. So whatever goes down has to come back up. But here, if the lowest performing stock is giving you 100%, this note will give you 125%. So the best thing about this note, one, your money is safe. You will not go down in price. Two, you make 15.5% as long as all the stocks are up at the end of year one. Three, if you go all the way to year five, because first year the stocks were down, two, you did not sell the stock, the note, and three, at the end of 5 years, you get 1.25 times of the lowest performing stock. So for me, this is a great note. It's issued by Morgan Stanley. It is purchased in your Charles Schwab account. So if you don't have an account opened with us already, you need to open a Charles Schwab account, and we charge a fee for managing your money. And we can buy this note for you. The minimum investment in this note for our existing clients is $25,000, and for new clients it is $50,000. But for those who join our webinars, spend time with us, listen to us, get educated, we usually lower the minimums for new clients coming through the webinar to 25K as well. Or if you have a situation where you have a kids account and it has only $10,000, we will make exceptions for you. So please reach out to us if you are interested in this note. Next slide, Jyoti.
Sudhir, sorry to interrupt. Other added advantage is within 1 year, even if the lowest performing stock is less than 15%, you still
You
get
make
that
15.
15. Yeah, so
Yeah,
Jyoti, if
yeah,
you can just go back a slide before. So that's an added advantage from Morgan Stanley.
yeah. So I missed that point. So it works as a dual direction. So it's called as a dual direction note. So even if the stock is down, you make to the extent the stock is down. So if it's down by 15%, you make 15%, So that's an additional advantage. So you not only save your, you not only protect your capital, you make money if you are up and down in year one, and in year five, you make 1.25 times of the lowest performing stock. Thank you for
Thanks, Sudhir.
bringing
Yeah,
that.
thank you. Yeah.
Yeah. I was sure that the next note is dual directional, but I didn't see the words there. So okay, so the next note, which is also a very good note, only difference being the bank here is HSBC, which gives you some diversification. Two, this note is has to be traded by May 14th, which means we have only 4 days. So there is a uh, time sensitivity there. And here the stocks that we are betting on are Amazon, Netflix, and Broadcom. Again, three best stocks, three S&P 500 stocks. And the beautiful thing about this note is that the call premium, meaning at the end of 1 year, if all the three stocks are positive, you get 43% versus 15% in the other note. So that's the beauty here. And second, if the stocks are down between 1 and 40%, you make the return also like the other note. So if it's down by 40, you make 40, right? And if all the stocks are down and it is down more than 40%, then the note goes to year three. And in year three, you make three times of the lowest performing stock. So let's say the lowest performing stock is Amazon and it's up 200%, you will make 600%. So sometimes, I personally, when I invest in these notes, I always feel, we don't want the stocks to be up at the end of year one. We want it to go to year three because you can make 3x or 1.25x or 2x depending on the terms of that note. Again, this note also has the same kind of minimums. It is with Schwab. And on the downside, the previous note was principal protected, meaning you would not lose even if one or all the companies are down by more than 50%. In this note, you have protection up to 40% and below 40% at the end of year three. Let's say Amazon is down by 50%, at the end of year three, then you will only get 50% of your money back. Okay, so there is a risk at the end of year three, but the stocks that we are, having as underlying assets here are all three solid companies. None of these three companies have underperformed in the last 10 years. Doesn't mean to say that it will do the same in the next 3 years. But given that this note is liquid, you can sell it anytime. Given that there is protection of 40% at the end of third year, given that the upside is 43%, in year one or 43% on the downside also in year one, this has all kinds of risk mitigation in place. This has all kinds of upside also built in it. So, if you have money sitting in saving accounts, if you have money sitting in corporate accounts, which you don't need for payroll and things like that, I would certainly suggest investing in this note. Okay, so seriously consider this note. Time is of the essence because the deadline for this is May 14th. Next slide. Okay, so we talked about two structured notes which are extremely liquid. And here we have a fund, which is a natural gas fund, which is not liquid, which is very illiquid. But the income coming from natural gas fund is between 1 and 2%, more like 1.5% per month. So you are going to make about 18% per year. And there is no taxation on that income because all that income will be covered by depreciation. and this fund will be holding your money for at least 8 to 9 years. And at the end of 8 or 9 years, they'll sell these wells, natural gas wells, to a private equity fund, and they will return you your money with a gain or a loss. So we don't know how 8 years will pan out because a lot of things can happen in 8 years. But the idea here very clearly is your income is between 1 and 2% per month or 18 to 24% per year. No tax on that income. And this fund that we are talking about is a $5 billion company. So their first fund is delivering 1.5% every month. We have seen that. And this fund is available to you at this point. We don't know when it will be fully subscribed. So if you commit for this fund, you don't have to put money right away. So the minimum investment for this fund is $100,000. They will not make any exception. And we do this through Charles Schwab. And you need to be a qualified purchaser, meaning your net worth, global net worth to invest in this fund has to be more than $5 million, $5 million or more. So including your assets in India or any other country, your US assets, but excluding your primary house. If it's more than $5 million, you are qualified to invest in this fund. You invest in this fund for very tax efficient income of 18 to 24%. You don't have to put the money upfront. Once you commit, it will take them 1 or 2 or 3 months for them to ask you to send the money, because they will not collect your money till they have identified, very productive, developed, proven wells in natural gas to invest. So very high quality fund, limited opportunity, but there are rules around who can invest. More than $5 million of net worth you can invest. So if you are interested in something like this, do let us know. We can help you. Next slide. Okay, so this is a opportunity which a few of our clients requested us. Most of you might have heard of SpaceX, OpenAI, XAI, Perplexity, all of these companies. Now we did a lot of pre-IPO investments in 21. One of the concerns that our investors brought up was illiquidity of those investments. They want SpaceX, but when they want money, they want their money back. Unfortunately, in real estate and in private companies, they are not liquid. You can't exit out of those whenever you feel like. So that was the request we had from our clients, and we got this opportunity. This opportunity is investing in all the companies that you know of where you would like to be participating. SpaceX, this fund is a $140 million fund. 14.57% of that is in SpaceX, Elon Musk company. And today the valuation of SpaceX is around $350 billion. When we did our SpaceX fund in 2021 and 22, we went in at $75 billion and 103. So our investments, our clients have done very well. They are at around 3x return in about 3 years. So you can hopefully make that kind of a return even in this fund at 350 billion. But the good thing about this fund, it is very liquid. The minimums are also very low. It's the same minimum 25K for existing clients. And you are getting access to all the beautiful companies, OpenAI, Sam Altman's AI company, ChatGPT, XAI, which is Elon Musk's AI company, Anthropic, Epic Games, Perplexity, the alternative to ChatGPT. So 80% of your money that goes in this fund is invested in private companies, and 20% of the money is invested in public companies like Tesla, Coinbase, and many other companies. So the liquidity here is because of the public companies. So let's say you invest $100,000 in this fund because you want access to all these private companies. It comes with the public company exposure, and if you want the money back, they will sell the public company exposure and they will return you your money. At this point, as of April end, 86% of the money is in private companies and 14% of the money is in public companies. So very liquid fund. Again, we do this through Charles Schwab. If you are interested in participating in any of these companies, do talk to us and we will be very happy to come up with a beautiful allocation for you. Let's say you come to us with $100,000 and you are like, Sudhir, Anup, tell me where to invest. We will help you with the plan. We will tell you, let's put so much in structured note of Netflix, Broadcom, and Apple, right? Amazon, or we want principal protected note. So we can come up with a plan which suits your profile. If you tell us that, hey, look, my kids are young, they're yet to go to college, I don't want to, you know, take too much risk. They're about to go to college in like a year, in 6 months. Since all of these investments are really liquid, we can exit out of it anytime. So talk to us, and we will be very happy to create a very nicely custom made, investment plan for you. Because to us, it doesn't matter. We have no vested interest other than your personal growth in helping you with the right plan. Okay, so whether it is pre-IPO liquid fund or natural gas fund or your structured notes, we also have private credit funds, we have private equity funds, so we have a lot of options. It's like going to a restaurant and looking at a 5-page menu. We have so many options. Now, what is right for you, we will guide, and then it's up to you to say yes or no or ask us for modifications. Next slide, Jyoti. Okay, I think that's the end of the webinar for today. But we covered a lot of stuff. We covered the market update, international versus domestic equity. We talked about multiple ideas for next week, the structured note, principal protected, the structured note with the 43% return on both sides, 3x return at the end, all liquid. So, if you have any questions at this point, feel free to type them and we'll answer it for you. And we'll try to wrap up this by around 12 o'clock, another 15 minutes to go. We'll try to answer as many questions as possible in 15 minutes. And after that also, if you have questions, feel free to email us to wealth@mytimeequity.com. And you see a QR code on the screen. Please scan it and join our WhatsApp group, because all the things that we talk, all the things that we showcase here on these webinars are posted in that group, including the recording of this webinar will be posted in that group. So please join our WhatsApp group. There is not going to be any junk there. It's only one-sided communication coming from me and my team. Join the group and we'll be super happy to help you with anything that you want on your investments, tax reductions, retirement planning, and estate planning. We are ready to take questions, right, Jyoti?
Yeah. So there, yeah. Yes, there are a couple of questions so far. Yeah. Can you share the informations over email? Yes, as Sudhir said, we will send the recording, the link, and then you can listen to that. And if,
Hey,
as I
one
said,
thing
that
I would like to add, Anup, here is if you are approaching us for the first time, we need to have a profile on you. It's like going to a doctor's clinic and doing your complete blood check and ECG check and weights and all that, before we recommend you anything. So we are dealing with money and we want your money to be safe. We want you to be safe. Your health and wealth has to do well for you. So if you are approaching us for the first time, we'll ask you a lot of questions. What's your net worth? What's your income? What's your family status and all of that? So that profile needs to be there on our records, because as a registered wealth advisory firm, we are bound to get that information from you. So that's step number one. Step number two is we need to get on a call and we need to ensure that whatever you ask us is the right investment for you. If we think that it is not right for you, we will decline your request to invest in that fund. Okay, but if something is very good for you, we'll also make recommendations. As I said, our interest is in your growth of wealth and your health. Okay, we all have to live peacefully. Money should not cause headaches, and our goal is to do that. Okay, yeah.
thanks, Sudhir. So that was, yeah, we will definitely share these recordings and then, reach out to us, share the details, and then we will take it forward from there mutually. The next one was how is this pre-IPO different from the one that was 4 years ago, the Oxguard Fund SpaceX? That is a
Yeah,
second.
yeah. So the SpaceX fund that we did in 2022 is an investment at $103 billion. It's an illiquid investment in SpaceX. So here what is happening is you are investing in a portfolio of companies, and the valuation of all the companies is done on a monthly basis. So for any reason, if you want to exit from this fund, you can exit at that valuation. Let's say today you enter the fund at $100 per share. When you exit, it is $105 per share. You get your $5 and you're done. Okay, so that is what comes here, is liquidity. And how is the fund liquid? It is liquid because 20% of your money, or 14 to be precise, is invested in public markets, which is liquid stocks. So if you want your money back, they will sell those stocks and give you the money. They won't sell the private companies because they cannot, right? Private companies cannot be sold unless there is another institutional or another big client who is interested in buying those. So that's the difference. This is very liquid for you.
Okay, thanks, Sudhir. The next is, can I decide the allocation of my money in the startup fund? For example, I don't want to invest in OpenAI, but I want to invest in Perplexity. Is that an option? I think the answer is no, but Sudhir, I will.
Unfortunately not, because this is a diversified fund. We try to get Perplexity from the market, but when we are trying to negotiate the deal, the fees are very high. So we usually don't want to buy something at a very high price, because what we want to do is buy cheap and sell high, right? So we decided to let go that opportunity. But here, this is like investing in S&P 500. You get access to all the 500 companies. Similarly, you get access to all the 140 companies. The good thing is diversification, and the bad thing is also diversification. You are not in one stock which may be a rock stellar performance, but you are part of 140 companies, out of which 40 may be great, 100 may not be so great. So unfortunately, that is the structure of the fund.
So then if I understand right, for the pre-IPO, there is no, it's either accredited or non-accredited, right? So that way it
That's
is
correct.
easier. Yeah.
That's correct. Correct. Anybody
Okay.
can invest. No accredited status is required, and the minimums are the same,
Yeah. So that's an advantage that we have.
and very liquid.
Yes. So far, these are the questions I am seeing. I'll probably wait for a minute. Jyoti, no other
Okay.
questions, right? Yeah.
Yeah. So we have the crypto fund open right now, and cryptos are doing very well. And Jyoti, if you have the slide, if you can bring it up, just to show the glimpse of our crypto fund. So please, think about, participating in crypto. If you don't have access to crypto on your personal side, our fund is a super diversified fund with very strong hedge fund managers managing 70% of the fund, and 20% is 30% is managed in long only strategy, which is in Bitcoin and four other altcoins. So crypto fund I would recommend. If you have spare money and if you don't want it to be spent or used for any emergency situation, or for something there where you need the money within 1 year, I would recommend investing in the crypto fund. So Anup, if there are no further questions, I think we can wrap it up. And we have shared our WhatsApp group as well as email address. So feel free to email us, and we'll be happy to answer any of your questions. But I think timing is great. Equity markets are down, crypto markets are popping, a lot of new opportunities in pre-IPO and natural gas and other asset classes. So if you're sitting with money on the sidelines, I think this is the time you should talk to us and decide what to do with it. Last but not the least, we also have bank funded life insurance plans. If you are looking to buy life insurance and you are now confused between, should I be putting my money in life insurance or should I be putting my money in these investments? So our recommendation is both. because we can get the life insurance funded by the bank, and we can get you to invest in these high performance stocks, high performance equity models, and crypto models. That way you can get the both of best of both worlds. With that said, thank you very much, guys, and Jyoti and Anup, thank you very much for being here. Let's talk next week again and give an update on the markets and other opportunities. Thank you, folks. Bye.
Yeah. Thank you, Sudhir, for enlightening. Yeah.
Thank you. Thank you, Sudhir.